Gold is positioned for a massive run right into the 43.780 level, but most retail traders, they're about to get trapped by a pre-news manipulation sweep. If you're trading XAUUSD today, you need to know exactly where smart money is engineering liquidity right now. Let's look directly at the institutional footprint.
Here is today's trading plan. My primary focus is a potential long setup targeting buy-side liquidity at 4307.8. But there's one condition that absolutely must happen first. The bias across both the daily and H4 timeframes remains strictly bullish. Our immediate goal? A sweep of the 4231.50 sell-side liquidity. We're waiting on the NFP catalyst to inject volatility, followed by a 15-minute market structure shift. That's the exact outcome we're hunting today. Now let me break down the why behind this setup.
Looking at the H4 timeframe, smart money has engineered a deep discount accumulation phase, and they've displaced aggressively upward, leaving bullish order flow firmly intact. Notice how price completely recovered from those major lows down near 39.30. These high-volume bullish expansion candles, they confirm institutional buyers still retain full higher timeframe control. This isn't a distribution phase. It's reaccumulation aiming directly for historical macro highs.
But here's the problem. Today is non-farm payrolls. Institutions require high-impact news volatility to deliver price across dealing ranges. The market rarely just drifts into major targets on days like this. It requires an injection of volume, a true catalyst. You should expect smart money to utilize that 7:30 p.m. New York morning session window to engineer liquidity runs, forcing early positions out before committing to the real macro direction.
Right now, price is just compressing in equilibrium around 4260. It's building relative equal highs and lows, basically accumulating retail stop orders on both sides of the market. On the H1 timeframe, we're sitting right in the middle of a massive expansion range. But shift your focus down to the 15-minute and you'll see this tight, coiled price action. Smart money is intentionally compressing the market, building a massive liquidity pool below 4231.50 and above 4270. They are winding the spring right before the news drops.
As the saying goes, smart money frequently sweeps internal sell-side liquidity to rebalance into a bullish discount fair value gap before expanding into major external buy-side liquidity. This is a crucial institutional footprint. They must acquire discount sell-side liquidity to fuel that primary expansion into our external targets. Basically, they need retail sell stops to pair with their massive buy orders. Sweeping internal liquidity to tap a deeper discount gap is the absolute prerequisite for a high-probability run.
This is where most traders get trapped. While retail is looking at the wrong level and trying to chase the initial breakout, let me show you where institutions are actually targeting. Retail traders often try to trade the initial spike the second the news hits, assuming that first move is the true move. But smart money's focus is entirely different. They are waiting for the Judas Swing. That's a highly deceptive move down to raid the 4231.50 support, triggering widespread panic, right before aggressive institutional buying steps in.
So, here is the exact executable 15-minute trade plan. Step 1. Do absolutely nothing until the 7:30 p.m. news release. Step 2. Closely observe the chart for a deliberate sell-side liquidity sweep right under 4231.50. Step 3 is your trigger. Wait for a 15-minute market structure shift backed by strong displacement back to the upside. And finally, step 4, enter your long position on the newly minted 15-minute fair value gap. Following this exact sequence ensures you are trading alongside the institutional footprint rather than becoming its victim.
Your highest probability entry zone sits perfectly inside the H1 fair value gap, right between 4220 and 4235 post-sweep. That H1 gap acts as your high probability intraday discount target. Now, there is a wider H4 gap below it that serves as our macro protection, but that 4220 to 4235 area, that's exactly where we want to see price reject immediately after sweeping the early buyers out of the market. Executing this precise model offers an incredible 1 to 3.8 risk-to-reward ratio. You'll want to take initial partials at the 4270 Asian high. Your stop loss gets safely tucked below the sweep low and the structural invalidation level. The professional way to manage this is scaling out 50% at that first target, leaving 30% for the external liquidity at 4307.80 and keeping a 20% runner for the macro expansion. That is how you manage a trade like a professional.
So is a trade actionable right now? No. Smart money confirmation has not yet appeared, and executing before the news presents a massive, unnecessary slippage risk. If you look at current 15-minute price action, we haven't seen a valid liquidity sweep, nor have we seen a structural shift. The market is effectively neutral in this immediate moment.
So we sit on our hands and wait.
The retail breakout trap, what most traders ignore. This is the scenario most traders are completely missing right now. It's a premature spike to the upside that traps early longs just before the real move lower. The market is currently resting just below relative equal highs around 42.65 to 42.75. A classic NFP trap is to spike price up into those highs, convince the retail crowd that the breakout is real, and then violently reverse to sweep the 42.31 level we actually want.
We must always define the point where our analysis is completely wrong. This 42.10 level becomes critical because a strong H4 body close below it entirely invalidates our bullish order flow model. If price closes deeply into that H4 protection zone, it's sending a clear warning signal. It means a deeper bearish correction is underway and any long bias is immediately canceled. This strict invalidation parameter is exactly how you preserve your capital.
However, there's a solid 70% probability that this market provides the exact pre-NFP liquidity sweep we are waiting for, followed by an aggressive expansion. The higher timeframe trend is undeniably bullish. We are simply waiting for an engineered intraday retracement. That retracement allows us to board the train at a heavy discount before it leaves the station and heads straight for those 43.07 macro targets.
Let's do a quick final recap of this explainer. We are holding a bullish bias toward 43.07.80, but you must remain patient. Wait for the 42.31.50 sell-side sweep and the subsequent 15-minute confirmation. Only enter after the news has purged liquidity. Your risk should be strictly capped at a maximum of 0.5% to 1% per trade, honoring that 42.10 invalidation level as a hard stop.
By strictly adhering to these institutional parameters, your overall execution confidence score for this setup climbs to a massive 85%. When you systematically combine a higher time frame bias, specific liquidity targets, time of day alignment with high impact news, and strict entry conditions, you remove emotion from the equation entirely.
And if you'd like to trade alongside these setups, you can find the FXTM account link in the pinned comment below. Having a highly reliable environment to execute high volatility events like NFP is crucial when you're dealing with precise institutional entry models.
If you enjoy institutional-style market analysis using ICT and Smart Money Concepts, subscribe to ICT Market Theory. But ask yourself, as we head into today's session, are you prepared to wait out today's NFP trap, or will your stops become the exact liquidity that fuels the next institutional move? Stay calm, wait for the sweep, and trade precise.